when you understand it from that context, it's not like the mistake that investors make is thinking, oh, real estate professional status is something that like I'm going to strive for, right? Like,
Right.
oh, my these other people are doing it and I've got to do it too. That's not what it's for. Okay. So real estate professional status was rolled out. So the passive activity loss rules were rolled out in 1986. Real estate professional status came a few years later
Hmm.
because what it was doing was preventing people that are in real estate full time from actually using their rental losses to offset their real estate business income.
Ah, that's
So they
interesting.
rolled out real estate professional status, the rules around it,
Hmm.
to enable that group to use rental losses to offset their real estate income. It was not meant to help physicians who are earning 800K a year also write off their rental losses. It was not meant to help people like me running a business to write off their rental losses against their business income, right? So it's just important to understand that context, because once you understand that context, you can understand how the IRS will attack you, and they will attack you.
Hmm. Hi, Adam Gower here, founder of gowercrowd.com and host of the real estate reality show at youtube.com/gowercrowd. Thank you for joining me today. My guest today is Brandon Hall, who is the real estate CPA. Oh, and goodness me, am I glad I called Brandon. So I've been researching this episode today is part of the tax series that I'm putting together, covering all the tax benefits and the real estate. I'm sorry, the IRS tax code as it applies to real estate. And I've been doing some research, and I found this document online. It's called the Real Estate Professional Status. It comes from Brandon's website. Strongly recommend it. You're going to hear me talking about it in the podcast. I'm going to put a link on the podcast page to this document. The real estate professional status you're going to learn about is a way of, well, gosh, I hate to use this term, but it is, if you are a real estate professional, you can offset income earned from non-real estate activities. I've probably got that wrong. Oh, by the way, my CYA here is I'm not an accountant. You can't take anything I say or anything said on these podcasts or shows as being any kind of financial advice or investment advice or accounting, etc., whatever. But it really should just be seen as being educational, something that you can dive into a little bit deeper with a true, real professional, right? See, like a CPA, qualified CPA, like Brandon, for example. Anyway, so I've totally lost my train of thought there. But the point is, I'm trying to be careful with the language that I use. But the point is that real estate professional status is a status that is recognized by the tax or in the tax code and is often ill-advised. I see people recommend all you need to do is to get real estate professional status and you can now save gazillions of dollars in taxes. It is not so easy to do that. So today's episode, finally, I'm going to get to it. Today's episode with Brandon Hall is going to get into exactly what is involved. If you want to, and so it's actually extremely interesting. Definitely a time well spent listening to today's episode. If you want to learn more about Brandon, I will put up links to the paper that he put together on real estate professional status, to short-term rental paper that he put up, his LinkedIn profile, his website, everything. You find it all there on the podcast page at gowercrowd.com. And if you've not already subscribed to our newsletter, please do so. It goes out every week. It's totally free, and you can always unsubscribe. All right, I've definitely talked too much already in this introduction. Get carried away. It's a really interesting topic. Let's just turn it over now to my conversation with Brandon Hall, the real estate CPA. Brandon, what an enormous pleasure to meet you. I mentioned this before we started, actually, just now, that I had the pleasure of reading your, actually, the first page says, stop paying 25% plus in taxes. I wish that was all I paid. I mean, you know, it's. And then the second part of it, real estate professional status, I have to tell you, is one of the best written, most thorough documents on any topic that I've read for a long time. Kudos to you. And what I'd like to do today, actually, is to go through that and just talk about the real estate professional status. What is it? How does it work? Why does it help? But why don't we start at the very, very top? Why don't you tell us who you are, what you do for a living, how you got there? Spend about 30 seconds on that, and then we'll get into the meat and potatoes of the rep status. Go ahead.
Sounds great. Thanks, Adam, for having me on, and I really appreciate the kind words. My name is Brandon Hall. I'm a CPA. I run a firm called Hall CPA. We are one of the fastest growing firms in the United States, and we niche in real estate. So we've got about 800 clients. They're all real estate investors to varying degrees, some extremely large, and many very new to the space. So kind of have a firm that can handle any sort of scale you throw at us, but it also kind of caters to the new retail investors. We provide advisory services, tax services, and accounting services. But yeah, I wrote this guide because I was getting a ton of requests, and people were just like number one, if you go on social media, there was just a lot of misconception out there. But at the time was doing all of our sales calls at the firm, and I just kept getting over and over and over. Well, that's not right. You don't know what you're talking about. I was like, dude, I just gave you the tax court case. So finally, I just sat down and wrote this thing. I was like, everybody needs to know this information. It needs to be more clear, better. So that was the inspiration behind it.
Yeah, it is really superb. And if you're okay with it, I'm not sure if you have a lead gen form on your website. If you do, I'll send traffic to that. If not, I'll put it up on the podcast.
Oh, 100%. Thank you.
Anyone could get hold of it. Yeah, it's really it's actually interesting reading.
Yeah, we've had like 29,000 downloads or something like that.
Have you really? It is.
Yeah.
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 You don't really. I mean, you got to decide that it's something you want to research. But this, to me, anyway. Look, I don't know much, but I know a lot more now. I've read this. It seems to be pretty authoritative, definitive, and an interesting read. So let's go through it. Why don't we start again with the idea of? So here's the distinction I want to start with to get to this discussion on real estate professional status. And that is the distinction between active and passive income for two audiences. Professional real estate or real estate professionals, people who are in the real estate business, they earn their money, their daily envelope, weekly envelope in real estate, or passive investors who are people that have other jobs, physicians, whatever, lawyers, accountants, other professional people who are not professional. So let's talk about those distinctions: passive versus active, and the two different types of investor.
Yeah, so the way that I like to think about it, and whenever I'm like speaking on this, I always start by explaining there are two buckets of income, and this actually applies to everybody that in the United States. Every single taxpayer these rules apply to, but we don't really learn about these until we start investing in real estate. So there's two buckets of income. There's non-passive income and there's passive income. Passive income is all rental real estate, unless I qualify as a real estate professional, which is the guide that we're talking about. But it's all rental real estate unless I qualify as a real estate professional, and any trade or business that I do not materially participate in. That is passive income. So that second piece that I don't materially participate in, that could be a hair salon, right? Like I could give $100,000 to my local hair salon for expansion capital, and as a result, I could get a profit share. But if I'm not materially participating in that business, which I wouldn't be, I don't know how to run a hair salon. I'm just the money guy. The profits that I receive back, those are passive, right? So that also goes into the passive bucket. And interestingly enough, my rental real estate, if it's also passive, the losses from my rental real estate can offset that passive business income. So that's a mistake that we see some tax providers make sometimes. They don't realize that real estate can offset non-real estate. It's just passive versus non-passive.
Right.
So
and dividends from stocks as well. That's passive, isn't it? It's by definition.
So
or am I going down a rabbit hole?
Oh my goodness. You would think that that's passive, but under Section 469, it calls that type of income not from a passive activity, which effectively makes it non-passive. So in your non-passive bucket, you have gain on stock sale, which I know sounds weird, but that's how these rules are written. You have gain on stock sale, you have dividend income, W-2 income, business income where you do materially participate. So my CPA firm income is in my non-passive bucket. And all these rules are trying to do is stop people from using rental real estate as tax shelters. That's effectively what they're trying to do, right? So they're trying to say, Brandon, you're running your CPA firm, you get dividends from Apple or whatever. I don't even know if Apple issues dividends, but you get my point.
Yeah.
And that's all going to go into one bucket. but all the rental real estate that you're buying, that's going to go into this other bucket, and those buckets can't cross pollinate unless you qualify as a real estate professional.
Right. Wait a sec. So, and what was I thinking about? Yes. Oh, it's also called earned income, isn't it? Is that what's the term actually that the IRS uses? Earned income?
Well,
The
the
opposite of
IRS,
passive.
the
Yeah.
Internal Revenue Code uses quite a few different terms, right? So there's ordinary, there's earned, there's portfolio, there's passive. But in the context of am I a real estate professional and what's the benefit of that, we're really just using two terms, non-passive and passive income. And so passive income, again, is any rental real estate, unless I qualify as a real estate pro, and any trade or business that I don't materially participate in. Those are the two types of passive income. Everything else is non-passive in the context of Section 469.
Right. And there's a wall in between these in terms of where you can take your deductions. So you can take deductions, if you're a business owner, you can take deductions that are directly related to whatever your trade is, that comes out of, that is deducted from whatever income you got there. But
Yep.
then this wall that sits in between that, or against that, is the one that is for your investments. So if you invest as a limited partner, for example, in a real estate deal, that behaves on its own. That has to take its own losses and income, etc. Right?
Yeah, yeah. Well, so yes and no. In the context of is it passive versus non-passive? Correct. So if I'm investing in a deal or in real estate and depreciation expense creates a tax loss for me, the question is, can I claim that tax loss? And if I can claim that tax loss, I either have passive income or gain on sale from a passive activity, or I'm a real estate professional and I can use that to offset my W-2 income or my business income. But that's kind of what we're trying to figure out
Yeah,
is
if
can
I'm
I
a real
claim
estate
the tax
professional.
loss?
Right.
Yeah.
It's actually the term is real estate. Oh, professional status. That is what it is.
Yeah.
So hang on, you're making some big leaps. This is an easy thing to do when you know everything about a topic. But let's start at the very top, actually. I keep saying at the top, we're kind of diving deeper. So the next level, what is depreciation? Why don't we start
Yeah.
there? So you kind of don't, let's not assume people know what that
Let's
is
go
and
up a
that.
couple levels. Let's go up
Yeah.
a couple levels. Okay, so when I buy a property, let's say I buy a $500,000 property. You can make me pull out my calculator here for this. So let's say I buy a $400,000
I mean,
property.
you can't do it in your head. Come on. Come
Yeah,
on,
I love
Brandon.
numbers, but not that much, man. All
I
right,
can
so
hear the wheels churning in your brain over there. You can do it. Go on.
all right, so I buy a $500,000 property. When you buy a property, a rental property, you have to allocate the purchase price between land and building slash improvements. The words are interchangeable, but land versus building. The reason I have to do that allocation is I can't depreciate land because dirt does not deteriorate, right? Dirt just stays dirt. It doesn't fall apart. But my building does deteriorate over time, and depreciation is meant to track that deterioration. And when we're explaining this to people that are new to real estate, sometimes it's like they'll challenge or ask, well, I thought real estate appreciates. And it's true, the value of the property goes up over time, but it's also true that the roof, the windows, the flooring, everything inside the property is actually falling apart due to wear and tear and just environmental factors. So depreciation is an expense that I get to claim every single year to track that deterioration. And I get the same depreciation expense regardless of how I finance the property. So I could pay all cash, I could 100% finance, I could do something in between. The depreciation calculation does not change. So here's how you find out your depreciation. Let's say I purchase a property for 500K. I've got to allocate some of that to land because again, land does not depreciate. So I'll do $100,000. Don't just do this willy nilly. By the way, there's an actual method to the madness. But for ease of this example, so I put 100K into land, and then I've got 400K left over. That's my building value. If I depreciate that, or if I divide that by 27 and a half years, why is it 27 and a half years? That's just what Congress decided. Okay. So 27 and a half years. So I divide it by 27 and a half years, and I get an annual depreciation expense of $14,545. So that means every single year that I own this property, aside from all the expenses that I already get to write off, I also get this added $14,545, which also means that if I cash flow 14,000 bucks and then I write off this depreciation expense, or I get to use this depreciation expense, I would have made money, but I get to tell the IRS that I did not make money.
Right.
Right.
I'm just gonna
That's the beauty.
interject there. So when you say
Sure.
cash flow, and we have to be very clear because this is the entire topic we're talking about. When you say cash flow, what you mean is that the rents that you get from this same property, or in
Mhm.
fact other properties, just to be clear, it can actually
Sure.
cross-pollinate across
Yeah.
others. The income, the net income. So after all your expenses and everything, rents minus all your expenses, that's the cash flow you're talking about. We're not talking about, to be clear. Oh yeah, so that's what we're talking about. It's cash
Yeah.
flow
Yeah.
from that or other similar properties.
Correct. Yeah. And so it's like and I use the word cash flow just to help people kind of like visualize it. Technically, we're talking about net operating income. But regardless, let's say that my rents were $20,000 on this $500,000 property, and then my expenses were $10,000. So my net operating income is $10,000, right? 20 minus 10 equals 10.
Mhm.
Well, I haven't factored in my depreciation expense yet. So now I take my 10K of net operating income, which is money that I actually earned, and I subtract from that $14,500 for
Of
my annual
losses,
depreciation.
right?
Yeah.
So
And
actually
so now I
lost.
get to tell the IRS that
Yeah.
I lost for $4,500,
Mhm.
even though I made money. That's the beauty of depreciation.
Right. And if you invest in a property as a limited partner, you use the term retail investors. So let's just call them passive investors.
Sure.
If you invested in a partnership that allows this to come through to you pro rata,
Hmm.
then you would get a K1, wouldn't you? I do like to be technical. So the
Yes.
K1 that would come from that partnership or from the syndication would say you earned, here's $10,000 of income that you
Mhm.
earned after all our expenses. And here is a statement that says you actually lost 14,000. So then what happened?
Well, the K1 would actually just net it all out for
Oh,
you.
it does. Okay.
So you would just see the end result. But it's important to understand that the same thing is happening
Mhm.
because sometimes we get folks that are like investing in their own portfolio and they're like, I don't know why I would invest in a large deal as an LP because I don't get all the tax benefits. It's like, well, you still get the same tax benefits. It's just pro rata. The same things are happening. It's just at a much bigger level with a bigger deal.
Right. But you do also, just to be clear, you do also have to be absolutely certain before you go into a deal that it is being shared with you pro rata.
Oh, yes, the operating agreement will tell you how all of that works. And if you don't know how to
Yes.
read an operating agreement, then you can run that by your accountant
Yes,
before
and
you
probably
go in
should
and do that.
because they can the pages on tax can be run very long and be
Yes.
ridiculously complicated.
Those
Uh,
waterfalls can get crazy.
so
Yes.
you do want to run that kind of stuff by an accountant before you get
Yep.
into the deal. I think that's very good advice.
Yep.
Um, right now, that's depreciation. So I've got these losses, but here I am. I got a day job, and I'm making whatever, call it 100,000. Actually, let's use 200,000. So we're an accredited investor making 200,000. I've got $4,000 of losses over here.
Yep.
Can I deduct that 4,000? He said, knowing the answer, from my $200,000 of earned income. Running a golf course or whatever I'm doing over
Good
there.
question. Yep. Okay. So if we back up a little bit, we had $10,000 in net operating income. We had 14,500 bucks in depreciation, and that nets out to a $4,500 loss. And the question is, what do I do with that $4,500 loss? Well, the loss came from a rental real estate activity. And because it came from a rental real estate activity, by default, the loss is considered passive. So it's a passive loss. Your ordinary income, your W-2 income, your income from running a golf course is considered non-passive income. Passive income and non-passive income are like oil and water. They do not mix. So the only way to be able to use that $4,500 loss against my other income is to qualify as a real estate professional, or there's a couple different ways, but or I could run a short-term rental, which we don't have to get into. But if I can qualify as a real estate professional, I can use the $4,500 to offset my regular income. But if I work full-time job, I can't qualify as a real estate professional. And that
Right.
is one of the areas, that's actually one of the things that made me write this entire thing. And that's because that's one of the areas that people mess
Right.
up
And so
all
now
the
this
time.
is, we managed to get to the nub of the conversation now. So what I read a lot is, people that clearly, I don't know, they've heard the term, think it's great, and profess that they have a solution that could get you into a lot of trouble. Having read this thing that you put out, oh my goodness, it's not easy. So, being a real estate professional, and the term is real estate professional status, REPS, but real estate professional, that what is that is basically saying that you are earning your income, your earned income, I forgot the ordinary income is from being a real estate professional.
Right.
Therefore, you can deduct those passive losses. But how do we become a real estate professional from the perspective of the IRS?
Yeah. So just some added context on that, because you're totally right. And I could tell you've read the guide, which is awesome. Prior to 1986, so 1986 was when these rules all went to play. Prior to 1986, you could work your day job, you could buy rental real estate and use the losses to offset your day job income. And so it's really important to have that context, because the intent of these rules is to prevent you from doing that.
It
And
was
when
the
you
Reagan.
understand,
Reagan did it. I was here in the States when that happened. Reagan
yeah, yeah,
changed the world, actually, at the time.
right. Well, and when you understand it from that context, it's not like the mistake that investors make is thinking, oh, real estate professional status is something that like I'm going to strive for, right? Like,
Right.
oh, these other people are doing it and I've got to do it too. That's not what it's for. Okay. So real estate professional status was rolled out. So the passive activity loss rules were rolled out in 1986. Real estate professional status came a few years later,
Hmm.
because what it was doing was preventing people that are in real estate full time from actually using their rental losses to offset their real estate business income. So they rolled out real estate professional status, the rules around it, to enable that group to use rental losses to offset their real estate income. It was not meant to help physicians who are earning 800K a year also write off their rental losses. It was not meant to help people like me running a business to write off their rental losses against their business income, right? So it's just important to understand that context, because once you understand that context, you can understand how the IRS will attack you, and they will attack you.
Hmm. Yeah, exactly. It's not designed to game the system. So, what is the definition of a real estate professional? And I do have some specific questions to ask. I think
Sure.
SDR is one that you've actually put into a different bucket, but let's leave that to one side. Why don't we go through what it means to be actually this to be a real estate professional? What is that?
So qualifying as a real estate professional is simply a way to unlock your passive losses from rental real estate. So it's a way to basically take my property out of my passive bucket of income and move it over into the non-passive bucket of income. Therefore, I can then use the losses to offset all of my income. So that's the unlock. To qualify as a real estate professional, you have to spend 750 hours in a real property trade or business. You also have to spend more time in real property trades or businesses than you do anywhere else. It's that second test that blows it out for anybody that's working a full-time job. So you're not going to be able to work a full-time job and qualify as a real estate professional, because if you work a full-time job, and sometimes we get this from physicians too, they're like, well, I'm 10 days on, 10 days off. Doesn't matter. The whole year, how many hours did you work at your job? If it's 2,000 hours, then to qualify as a real estate professional, you have to spend more time in real estate. So I have to spend
2001 hours.
2,001 additional hours, 4,000 working hours during the year. Now, when I started my firm, I was working 80 to 100-hour weeks. I get it, right? You can do it,
It is.
but you are going to struggle hard to convince an IRS agent or tax court judge
Okay, so I'm
that
going
that
to
was
jump in
possible.
here and let's just be really clear because this is actually really, really cool stuff. I've heard this before with use how you use your car, any kind of food that you deduct if you travel and entertainment. Everything has to be as it has to be logged very clearly. I used to have a paper
Yes.
log.
Yes.
And so I can go back and say, yeah, this is who I met and this is what I did. And I've got emails that show that and everything. How do you demonstrate when you say it's hard to persuade the IRS? Well, it's not. It's not. It really, it's not a. I don't think of this as being a kind of a competition in any way. If the IRS says prove that you're a professional, real estate professional, what do you have to do that? I just explain what is the process of proving that you are a professional.
So to prove that you are a real estate professional, you're only ever going to have to prove it if you get audited. right? That's when you need to have good substantiation for any tax position that you've claimed on your tax returns. And with real estate professional status, the substantiation is a time log that you keep on an ongoing basis. If you are caught under audit having to recreate a time log, that will automatically be a mark against you and against your credibility, which is very important whenever you go to tax court if you were to continuously challenge the audit. So you have to keep a time log on an ongoing basis. The time log has to tell uh, whoever is reviewing it what dates I was at, what properties, what did I do, and it's got to be reasonable. So that's pretty much the rule. Now, what we do is you go to the tax court rulings and you start reading those to understand the nuances, right? Because keeping a time log, I can do that, right? Not a big deal. But what you do is you go to the tax court and you go to their rulings and you start reading about taxpayers that lost and why they lost. And taxpayers lose all the time with real estate professional status. That's the really key important point that I want everybody listening taking away is that this is not a joke. This is not something that you take lightly. Taxpayers lose because they inflate their time. So they spent 3 hours shopping for coffee filters in Bed Bath and Beyond. They spent 25 hours repairing a toilet,
Nice.
48 hours hanging blinds. Like they just inflate their time to just ridiculous levels. There was a case where the taxpayer said it took him 2 hours to review an email, and the email was literally, "Got it. We'll see you next week." It's like a one-liner. Oh, it took me 2 hours to review that email.
It
So
was
the point is
probably a
that
lawyer. Sorry.
you might be right. But the
They
point is
proved it. I billed for 2 hours.
actually on that note, there
Look at
was
my
a
billings.
case.
That's how I do it.
There was a case where the taxpayer presented their time log, and then they were trying to show that they worked more in real estate than they did their day job. But and so they presented what their day job working hours were. But then when the time card was actually pulled from the day job, it was different. And so now I'm like, oh, now you got a real problem, right? It's like now I'm lying to my boss. Not only am I lying to tax court, but I'm also lying to my boss. So anyway, your time log has to be reasonable. It's got to be real time, real participation time. It's not like the education and the research and all that junk. And you have to be prepared to. The way that I like to explain this to everybody is 3 years from now, if you're getting audited, you better be able to explain every single entry. Okay, and your any geo data that the IRS could pull better match up with that time log. There was a tax court case where the woman was claiming that she was at her rental properties every weekend from like 9 to 1 p.m. doing maintenance and repairs. They pull credit card statements and realize she's actually traveling in London
Yeah, this you
during the
sent
time.
out an email. It's actually I got on your list. It's extremely good. I mean, I recommend
Thank
it.
you.
Yeah,
Yeah,
it's really good. Real estate. How credible will you look under audit? In fact, this came out.
exactly.
When was that? Yeah, just earlier, middle of last month, actually.
Yeah.
Today being February already. So,
Yep. Yep.
hmm.
So it's just you just gotta the mistake that people make two mistakes with real estate professional status. One, they say I'm going to do it because I want the tax deductions and I don't care what risk I'm taking, and they underappreciate the risk. This is one of the most audited and litigated pieces of the entire tax code. So that's mistake number one. Mistake number two is inflating and lying and just not being true about their time log. And I get it, man. It's hard to track time in a real way that especially when you've got potentially $50,000 of tax savings on the line. It's
Well,
hard to not
let's
push
also
it.
be let's be clear about it. 750 hours, that is 3 hours a day, 15 hours
Yep.
a week,
Yep.
without a break throughout the year. So it's 3 hours a
Yes.
day. And call it with breaks, 3.5 hours a day. I don't know. I'm guessing probably
Yep.
what it works out at. You do kind of you mentioned that it's easy to keep a log. It's actually not easy to keep. It might be for somebody who, and I don't know if you bill by the hour. Some people do. A lot of my team do. So they've got used to it. I don't. I find it tedious. But can you use, for example, email log? Could I walk in there and say, look, here's 20,000 emails that I sent out, time stamped. Here's exactly what I was doing. Here's all my appointments. My calendar from Zoom or whatever it was, or however. Can
You
I?
can use a calendar. In replacement of like an actual time log, a calendar will suffice. Sending all of your emails might not cut it. That might be, sorry, that would actually be good substantiation. All right. But that would also require you to retroactively create that time log. So you're already on the losing end of this when you get audited. So my advice would be either use a Google Calendar or some cloud-based calendar, or use like Google Sheets, because it's a cloud-based Excel app essentially that you can use on your phone. And so you can just add entries as you go. And you don't
Right.
have to do it like every hour. You can do it once a day, once a week. But I think if you get past once a month, that's when it starts getting a little sketchy.
Now, right, so that's a real estate professional. What are the kinds of things that a real estate professional needs to be, or that somebody needs to be doing to qualify as a real estate professional? For example, you said, I'm an accountant, and here you are, all you're doing is working with real estate clients. I'm also, I do marketing, and all we do is work with real estate clients. We are only working on real estate projects 24/7. Well, however many hours a day it is, 20, whatever. But what are the kinds of tasks that are definitive of being a real estate professional? What does not fall into that, even those that you think might?
Yeah. So to answer that, I'm gonna first answer the real property trader business question, because you're right. Like, I'm an accountant. Our niche is real estate. So can I qualify as a real estate professional? And the answer is no. To qualify as a real estate professional, you have to spend hours, those 750 and more time than anywhere else, in real property trades or businesses. So working in real property trades or businesses. There are 11 defined real property trades or businesses. Um, Being an accountant is not one. Being an attorney is not one. Being a marketer is not one. Interestingly, there is a real property trader business called brokerage, but being a mortgage broker is not a real property trader business, because being a mortgage broker is putting together buyers and sellers of notes, not buyers and sellers of real property like an agent would do, interestingly enough. So that's the context that we have to view this from. But if I'm working in a real property trader business, to answer your second question, what type of time counts? It's the litmus test for this is basically, did I move the business forward with this, or was that time not needed? Okay. And so that's basically, like, to summarize, that's what it is. So people will always try to log education and research time, right? Oh, the time I spent listening to this podcast, knock me down for another hour or write me down for another hour, right? But it doesn't work like that, because this isn't actually going to move your real property trader business forward. It's not, this podcast, listening to this episode is not going to help you collect rents. It's not going to help you pay bills. That's going to happen regardless, right? So you got to think in those terms. So education is not going to count. Research is not going to count. Simply underwriting deals and finding new geographic locations. Yeah, we would all love that to count, because we can all leave Zillow and realtor.com up on our computers for 8 hours a day and say, aha, I'm a real estate professional. But again, that's not doing the real work. So education research hours aren't going to count. Travel time's typically not going to count, though asterisk, it could count if all of your properties are local to you and you have to travel to them on a consistent basis to keep them up to speed or keep them working properly. But those are kind of like those main hours. And then the last big bucket is investor level time. And this is the area, is education and research. People can get past that, once they understand it. But then we get to investor level hours. Man, this is the area that blows everybody up. So investor hours. What are investor hours? Investor hours are underwriting deals, sourcing deals, getting financing on deals, bookkeeping, paying the bills, doing your tax returns. Basically anything that any investor would do to make sure that their investment produces is investor level hours. And investor level hours do not count for real estate professional status or material participation unless you are running the day to day. So if you have a property manager, then all that time is all of a sudden dead. It doesn't count for you. If you don't have a property manager, you could probably make the argument that you're running the show on a day-to-day basis, and now all of a sudden, all of that investor time will count.
Investor time. Yes, it's so easy to confuse that term. Investor. You've got professional investors, you have passive investors. What do you mean in this context? Actually, what is investor time? What exactly does that look like? Well, like
Well,
what's
it's interesting because on one of the podcasts that I run, we actually just had this discussion about how a general partner in a fund could actually scale to be big enough where all of their time is now considered investor level time. But at that point, they've got so much real estate activity that it doesn't matter if it's passive or non-passive. So the investor level time is studying, reviewing financials. It's compiling summaries. It's monitoring the finances, paying the bills. It's basically all the stuff that any investor would do. And then there's the difference of I'm on the ground running the show versus I'm just checking in. That's the difference. You can be both, but if you're the person just checking in, then the efforts that you put into this will not count.
right? So, yes, really, really, this is why you got to talk to somebody who knows what they're talking about. I'm still confused. You said like finding new deals or
Yep,
underwriting. On the one hand, you said did not count,
correct.
but it does if as an investor level. No, is
Yeah, so if you're doing like some underwriting and if you're sourcing financing and all of that due diligence that goes into actually acquiring the deal. Like if you're just saying, yeah, I've researched for 5 hours a day and I didn't come up with anything, that's what I mean by research time. But if you
uh,
actually find a deal, the time attributed to that
uh,
is investor level time. But if you actually run that deal on a day-to-day basis, then that investor level time actually counts.
right, I see.
Right?
So if you then go out and buy a property and hire a manager to run it, you just blew that up.
Correct. Yes. And there's multiple tax court cases where that's exactly what happened.
Got it. Okay. And what about
Yeah.
real estate agents? People who got a license to sell single family homes.
Yeah.
So how does it work for somebody in that world?
Yeah, so first thing to clarify is getting a license does not make you a real estate professional. And not you didn't imply that, but we get that question all the time. So being a real estate professional again is 750 hours and more time spent working in a real property trader business than anywhere else. But being a real estate agent is included in that brokerage real property trader business. So you can be a real estate agent and your time spent being a real estate agent will count towards qualifying as a real estate professional. And the cool thing about qualifying as a real estate professional too is you don't have to get all of your hours in one real property trader business. You could be an agent for 300 hours, a property manager for 300 hours, and then manage your own rental for another 300 hours. You'll have 900 hours. And assuming that's all you do, you're a real estate professional. You can combine the time in all of the real property trader businesses that you participate in.
So if you're an agent or a broker, does trying to find homes to list the time spent, does that count? For example, showing them presumably like
Yeah. If you're doing it on behalf of clients and you are actually doing it, because sometimes we've got folks that get their license and then they're just kind of looking around for a long period of time and there's no production, right? That's when it gets a little squirrely. Now we're kind of going back into that research bucket that doesn't count.
right.
But if you're actually making money from it and you're actually showing the property and you're seriously running a business, then yeah, 100% that time will count.
Mm. And then it also, the other interesting part of this is that your spouse can qualify as a real estate professional, even if you don't, and your combined income then all goes into this bucket that can be offset against passive incomes. Talk about that, will you?
Yeah, that's beautiful for high income earners. So if you're a high income earner and if your spouse stays at home or works a part-time job or runs a part-time business, your spouse can qualify as a real estate professional. So you can work on funneling your high income into rental properties. Your spouse can manage those rental properties. And in a year that your spouse accumulates enough hours, again, 750 and more time in real estate than anywhere else, then your spouse qualifies as a real estate professional. As long as you file a married filing joint tax return, then we kind of think about it as your entire tax return is a real estate professional status tax return. So as long as your spouse qualifies as a real estate pro, you file a married filing joint tax return, then you can run the cost segs, you can boost your tax losses, and you can use those tax losses to offset your high income, regardless of the source.
Because then I'm looking at your list here of the contents page. I think we've covered really most of the the major points. I do want to go to STR in a moment, but
Okay.
is there any other kind of highlights that I've missed with the real estate professional status? I mean, it seems like you've touched upon most of the major issues here.
Yeah, yeah, no, I think we did a good job. Yep.
All right, so STR, short-term rental, an Airbnb rental. Let's touch upon that because that is. Have you got time, by the way?
Oh
We've got
yeah, yeah,
a
yeah.
couple more
I've got
minutes.
time.
Okay.
Yeah.
All right. So how does that feel? Let's say you've got one Airbnb down the road. Presumably your spouse, who otherwise would be looking after the kids, couldn't justify 750 hours looking after one single, rental down the road. But you did mention the STR exemption, or I forget the term you used. Talk
Yeah.
about that.
Yeah. Okay. So when you buy a rental property, again, the rental property is by default passive. Technically, what Section 469 of the Internal Revenue Code says is all rental activities are passive unless you qualify as a real estate professional, right? So that's where real estate professional status comes into play. But if you go to the regulations of Section 469, it defines what a rental activity is not. And in that definition, it says if you rent a property on average 7 days or less to customers, so if your period of customer use is 7 days or less, then you do not have a rental activity. Okay.
Seven
So,
days during what period? During the year?
yep, if your average period of customer use during that 12-month period is 7 days or less, you do not have a rental activity. And again, real Section 469 says all rental activities are passive unless you qualify as a real estate professional. So if I don't have a rental activity, I don't have to worry about that rule. So I do not have to be a real estate professional as long as I do not have a rental activity, right? Makes sense. But short-term rentals are not rental activities, and this is where everybody gets a little confused. So a short-term rental, 7 days or less average period of customer use is not a rental activity. Thus, I do not have to worry about real estate professional status. The only thing that I now have to worry about is materially participating. There are 7 tests for material participation. Most of our clients that utilize this are trying to hit the test of 100 hours and more than anyone else. And that comes with a whole bunch of landmines because you do have to be able to prove that you worked more than anyone else. So if you have anyone else working on your property, you have to track their time to be able to show that you worked more than them. But that if you can achieve that, buy your property 7 days or less on average, customer use, 100 hours and more than anyone else of actual work. Same rules apply with like hours that count and don't count with that 100 hours more than anyone else. Then you can use the tax losses from your short-term rental to offset your W-2 income. And you can do this as you don't have to have your spouse do this. Like I could do this. Well, I mean, I've got my spouse, but if I was single and I had a W-2 job, or if I was single and I was running this business, I could buy a short-term rental and I could do this exact same thing because real estate professional status is the blocker for full-time employees and workers. But this avoids real estate professional status. Does that make sense?
No.
The good news is we have a whole podcast on it.
I
Where
am
we,
so
like 7
totally
episodes
confused.
of
What?
this.
7 hours or less or something. I mean, that's just I can feel my eyes spinning over here. I don't know if anyone can see it. Sorry
the
to be so
key,
straightforward.
the key here is
I'm
just
just betraying my total inability, even though I've got a PhD, to actually understand anything to do
the,
with the
the
tax
key.
code.
The
Yeah.
key to understand is rentals are passive by default. I have to qualify as a real estate professional to make that not true. And I want to do that so that I can use the losses to offset my W-2 and my business income. But I can't qualify as a real estate professional because qualifying as a real estate professional means that I have to work more in real estate than anywhere else. So it blocks people working full time. But a short term rental gets to skip all of that because a short term rental is not a rental activity, technical definition. And because of that, I don't have to qualify as a real estate professional, which means that I doesn't matter how much time I spend at my day job because the blocker of the day job is in real estate professional status. It's in that definition. So this kind of skirts around it. It gets around it and it enables me to buy beach homes and mountain homes and whatever Airbnb homes up the street, cost segregate them, materially participate in them, and use the tax losses to offset my W-2 or my business income.
But can I offset other passive losses from other properties, like
Yeah.
through a syndication as well?
So your syndication losses are still going to be passive because they're going to be rental activities, right? Well, if the underlying investment is a rental activity, then it's still going to be rental activity.
Oh, as long as you're not actually really renting it, you can take the losses. Is that the point? Less than 7 days in a year, is it?
So the big question that you have to answer is, whatever activity I have, is this a rental activity or not? And if it meets the definition of a rental activity, you now have the hurdle of having to qualify as a real estate professional. If it doesn't meet the definition of a rental activity, to make it non-passive, meaning to offset my regular income, I now have to materially participate. So, like, a few years ago, there were a bunch of like ATM syndicates out there that were basically promoting that, hey, these are not rentals. So when you invest and we do all the bonus depreciation, you can use that to offset your W-2 income. But that's not
Uh,
true, because even
I'm
as
not.
an LP in an ATM syndicate, yeah, we're not rentals, but as an LP, I'm still not materially participating. So it's still passive for me, even though it's not a rental activity. Does that make sense?
Okay, now I'm getting a little bit closer.
Okay. Okay.
Yes, yes. I'm sorry. I do want to just try and just finish this point up, and then we'll ask
Sure.
you how people get in touch with you. Um, so you have a rental you buy a home down the street, and technically you can't rent it as long as you don't rent it for more than 7 days a year, correct? Seven
Yep.
days a year. Uh, what I'm confused is, what are you participating in if you're not actually renting? You just got an empty home there. Is that the point? Like, if I put it up on Airbnb, as long as I don't rent it for more than 7 days,
Yeah.
and I'm active in not renting it for more, see what I mean? It's like I'm like losing this connection here.
I
I'm either
see.
spending 100 days trying to rent it, hours, or I'm spending 100 hours, what?
Well,
Like
you do
trying
still
not
have
to
to
rent.
actually rent it. So if you don't rent it, then you're not going to be able to prove that your average period of customer use was 7 days or less. That
Seven
makes sense.
days for the whole year.
Think about it like this: if I have a person stay for 10 days, and then I
Yeah.
have another person stay for 4 days, the average is 7. So
Oh, this you mean
that's how we're.
consecutive days?
Yes, yeah. Well, it doesn't have to be consecutive. I could have somebody stay for
Oh
10,
gosh.
2 weeks
Okay.
in between. Somebody stays for 4. Next person stays for
So
3.
I could
So
have 6 days. So I could have like, could it be rented throughout the year without any vacancies for 6 day periods?
100%. Yes.
That's the point you make. Okay,
Yes.
that's what I didn't get. I was thinking 7 days for the whole year. It's like,
No.
well, you mean
Yeah.
seven consecutive? Okay,
Average.
average.
Yeah.
Okay, so as long
Yeah.
as, like, if I rent it for every single weekend for the
Correct.
whole year, I'm good to go. It's like 3 days of
Yes.
it. That's got
Yes.
it. Okay.
Yep.
Okay, now the light bulb for anyone watching just suddenly went off over my head. Finally. Okay, good. Now I understand. Let me ask you one final question before I ask you a final question.
Sure.
Do you have an STR, short-term rental document, as superbly well written as you've got this one? And if not, please put one together.
I actually think that we do. It's on a different page. I'll chat
Send
it
me a
over to
link,
you.
will you? Because
Yeah,
I
yeah, yeah.
actually
I'll do
really enjoyed this real estate professional thing.
I'll do that.
And I would love to read the short-term rental. Brandon Hall, you are a absolute goldmine of knowledge and wisdom and understanding of the tax code. Specifically, I love that you are so boldly the real estate CPA. How do people get in touch with you other than going to the podcast page at gowercrowd.com?
Yeah. So two ways. First, I've been doing this thing on Twitter recently where I take TikTok videos of really bad tax advice and I write about how it's bad. So follow me on Twitter. It's at bhallcpa. But the other way to contact us is if you just go to our website, www.therealestatecpa.com. We've got a ton of resources there that you could check out: podcasts, guides, blogs, all that stuff. And then obviously we also have the become a client form there if you're interested in the conversation. So that's the best way to contact us.
Brandon Hall, the real estate CPA, enormous place. Thank you so much for joining me on the show today.
Thanks so much, Adam. Happy to be here.
All right, that was Brandon Hall, the real estate CPA, talking about the real estate professional status. As you can see, it's not easy to get. It is You really got to be a professional or professional in the real estate industry. And there are all kinds of definitions for what actually qualifies you as being a real estate professional. If you want to know more about Brandon, access those papers that we talked about today. Go to the podcast page at gowercrowd.com. And while you're there, do please subscribe to our newsletter. It goes out every week. It's totally free, covers the world of real estate syndication and crowdfunding. And we look at the news and offer educational courses, and most of it's free, some of it isn't. Anyway, it's all there at gowercrowd.com, and just under the subscribe button there, you'll find. Brandon, what an enormous pleasure to meet you. Really, really enjoyed our conversation today. You are clearly, it's so refreshing to meet somebody who exclusively focuses on a particular area of the real estate. I'm sorry, of the tax code, in your case, real estate. It does require, it is a specialization in and of itself. I'm grateful for you, to you, for having been specializing in that area and for having joined us today to talk about real estate professional status. Thank you also, dear viewers. I really appreciate you spending the time. And for today, let's wrap up, and I'll see you next time. Today, this is Adam Gower signing off.